In this chapter, we're going to cover income taxation of trusts and estates. And this is an interesting topic in tax because a lot of trusts and estates are created for purposes other than tax. So you'll see that here in our concepts that sometimes things that might be good for tax purposes aren't going to be done because the purpose of the trust or the estate was not a tax planning purpose. So trusts and estates are fiduciaries, and what that means is they safeguard funds for the benefit of another. So both of these vehicles basically collect and hold funds that don't belong to the management of these vehicles, but these people are fiduciaries for the beneficiary of these assets. The taxing rules are almost identical between trust and estates, and so we're going to talk about them together. In a trust, we create it when a grantor or trustor transfers assets to a trust, which is administered by a trustee on behalf of a beneficiary. So you can see there's three entities here. A trustee could be an individual, or a trustee could be a bank who manages trust. But either way, there's a person, a grantor, who transfers assets to a trust. The trust is managed by this third party called the trustee, and the management is on behalf of a beneficiary. These can be created during someone's lifetime. This is an inter vivos trust, or it could be a testamentary trust, which doesn't begin until the grantor passes away. An estate originates on the death of a person and continues until the administrator or executor completes their duties. So an estate administration can be short or it can be long, depending usually on the value of the estate. But the whole purpose of an estate is to collect all the assets of a person who's deceased and distribute them either according to their will or trust document or the laws of the state in which they died if they had no will. You might create a trust for tax savings, but you might also create a trust for non-tax asset protection. Wealthy parents often create trusts to support their children, but to make sure their children don't get access to a whole bunch of money all at once. Or if you have maybe a child or a relative who is mentally incompetent, you could create a trust for their protection where that trust is designed to pay out for their care, but is designed not to allow them to have access to all of those assets all at once. So principles of fiduciary taxation include that trusts and estates are separate taxpayers, kind of like a corporation, it's a separate taxpayer. There is no double taxation because there's a deduction for income distributed to beneficiaries. If a trust or an estate pays out income to a beneficiary, that trust or estate does not pay tax. We use a conduit approach, which means that income retains its character when it's passed through to a beneficiary. And the same tax rules apply to estates and trust as to individuals, unless they're modified by subchapter J. So most of this stuff is going to seem familiar to you because it's exactly the same as the taxation of an individual. We first have to decide if we have income or principal. So income versus principal. A principal is generally what you think of. The corpus of the trust that was transferred in trust is the principal. And then we're going to talk about other things that we classified as principal. The assets that earns, the money that earns, is generally income. A distribution from the trust may be limited to income from the trust. It often is. So every year, the trust may be allowed to pay out all the income but none of the principal. Income in this sense is often different than tax income. And we'll have net accounting income and we'll have tax income. So net accounting income is the excess of accounting gross income over expenses charged to accounting income. And again here, the important part is that we're distinguishing income from principal. The income from principal is usually defined by state statutes, and most states follow the Uniform Principal and Income Act, which we're going to refer to as the we are going to refer to it as the Uniform Act. Income is usually defined as the current return from a principal asset. Some things classified as income are rent, interest, dividends, a portion of receipts from royalties from mineral interest, etc. So 10% of the royalties from mineral interest. Things that are defined as principal are property held in trust for distribution to a remainder beneficiary when the trust terminates. So everything that's principal will be distributed out upon termination of the trust. This includes sale or transfer of principal property, capital gain dividends, life insurance proceeds, and a portion of receipts from royalties from mineral interest, so 90%. So when we have mineral interest and we get royalties, it's going to be split between income and principal. 10% is going to be allocated to income and 90% is going to be allocated to principal. Expenditures chargeable to income include ordinary expenses, half of the compensation of the trustee, the income tax payable by the trustee levied on receipts classified as income. So when we're computing net accounting income, we get to take these expenditures as a deduction against that income. And then expenditures chargeable to principal include principal payments on debt, half the compensation of the trustee, tax based on receipts allocated to principal even if the tax is described as income tax. When we have depreciation, the trustee may decide whether to charge that to income or principal. If it's charged to income, it's going to reduce the amount that can be distributed during the year. And this discretion may be overridden by the trust instrument. So the instrument, the contract that creates the trust, may specify how to treat depreciation. And here is a graphic displaying how to calculate the net tax liability. So we start with gross income, which is the same as we have for individuals. And then we have deductions for expenses. And we have in parentheses in there some common deductions. Then we subtract the distribution deduction. And the maximum distribution deduction is the distributable net income minus net tax exempt income. And we're going to define that in a later slide. But this right here is how we avoid double taxation, because we are allowed a deduction for the distribution that is distributed to the beneficiary up to a max of distributable net income. From there, we get an exemption deduction. That's our taxable income. Then we compute our tax, we subtract credits, and we get our net tax liability. So as you can see, if we are distributing all of our income as a form of distributable net income, we won't really have a tax liability in a trust. Gross income is the same as that of an individual, but classification will differ between tax income and accounting income. I am allowed a deduction for expenses, and those expenses deductible generally mirror that of individuals, but they do allow a deduction of a trustee's fees and then any tax return preparation fees. The executor can deduct expenses on the estate's income tax return if they're not deducted on the estate tax return. So an estate will have an income tax return depending on how long the estate is open, and an estate tax return, again, depending on how large the estate is. So the executor of the estate can collect all the expenses of administering the estate and can decide where to deduct them, the estate income tax return or the estate tax return. A charitable deduction is unlimited if it's authorized by the trust instrument, and depreciation or depletion deduction is available to the estate or trust if not allowable to the beneficiaries. We also have simple trust and complex trust. In a simple trust, all the income must be distributed annually, and the trustee may not make charitable contributions. The trust must distribute all accounting income, and they are allowed a deduction for all accounting income, but the deduction may not exceed distributable net income. So in a simple trust, we generally should not have a tax liability because we're distributing out net income every year from the trust. A complex trust is not required to distribute all income currently. Their distribution deduction is going to equal the sum of the income required to be distributed currently and any other amounts properly paid, credited, or required to be distributed for the year. And again, the deduction may not exceed distributable net income. So under a complex trust, we definitely may and probably will have income tax liability of the trust. We're also allowed personal exemptions, which if you are familiar, the Tax Cuts and Jobs Act eliminated those for individuals for the purpose of calculating individual income tax, but we still are allowed those for trusts and estates. So an estate is entitled to a $600 exemption, a simple trust receives a $300 exemption, and a complex trust receives a $100 exemption. Credits are generally the same as for individuals. And now on to distributable net income. So this is an important number because it's the maximum amount of distribution taxed to the beneficiaries and the maximum distribution deduction that can be taken by the beneficiary. So when we have a trust and we're distributing out income, we said that we get to take a deduction for distributable net income, and generally for a simple trust at least, the trust doesn't have tax consequences. But the individual receiving that income is going to have tax consequences, and the distributable net income is going to equal the maximum amount of distribution they're going to be taxed on. So it's going to represent their max tax consequence. It's also going to determine the character of the beneficiary's income because of the conduit approach. So remember, it retains the character flowing through the trust. The distributable net income equals the fiduciary's taxable income adjusted as follows. We start with taxable income. We do not take a deduction for the distribution. We do not get a personal exemption. And then capital gains are not included and capital losses are not subtracted unless such gains and losses are allocated to accounting income instead of to the principal. Extraordinary dividends and taxable stock dividends are not included if they're allocable to the principal, and an addition is made for tax-exempt interest minus expenses allocated thereto. To determine distributable net income, I have two choices. I can start with taxable income exclusive of the distribution deduction and then make the adjustments required by the code. So if I do that, I start with the taxable income excluding the distribution deduction. I add back the personal exemption. I subtract any capital gains or add capital losses, and I add back any tax-exempt interest, net of allocable expenses. I could also start with net accounting income, so this is choice 2, starting with net accounting income, and reduce by expenses charged to principal. I may not be 100% correct in choice 2 in limited situations, so generally choice 1 is better if I have enough information to use choice 1. All right, here we have a trust. It has net accounting income of $24,000, and it incurs a trustee's fee of $1,000 in its principal account. What's the distribution deduction under the following situations? So A, it distributes $24,000 and all of its income is from taxable sources. Okay, so it's all taxable. So the only adjustment we're going to have to make is the trustee's fee of $1,000 because it was charged to the principal account. Remember, it's charged to the principal account. It wasn't distributed. So distributable net income is accounting income minus the adjustment for the $1,000 charge to the principal account. So D&I is $23,000. B, it distributes $24,000 and it has tax-exempt income of $2,000. Okay, so now we start with our $23,000 distributable net income, and we subtract the tax-exempt income to arrive at the distribution deduction of $21,000. And again, this makes sense if the tax-exempt income is not taxable, we don't also get a deduction for it. All right, part C, it distributes $10,000 and all of its income is from taxable sources. Okay, so now we don't get a distribution deduction of more than what we actually distributed. So we get a distribution deduction of $10,000. Our distributable net income is still the $23,000, but we don't get to take a distribution deduction unless we actually distribute it out. So the $10,000 represents our distribution deduction. Here we have the Trotter Trust. It has receipts and expenditures listed below for the current year. Assume that the Uniform Act governs an item's classification as principal or income. The trustee's fee is charged 1/2 to principal and 1/2 to income. What's the trust net accounting income and the maximum amount it can distribute? Assume the trust instrument precludes distributing principal currently. Okay, so just looking at this, we have dividends, interest on tax-exempt bonds. We have loss on the sale of a capital asset, rental income from land, and property taxes on rental property, and a trustee's fees. So first we need to determine the net accounting income. And we do this as follows. We have the dividends, the tax-exempt interest, the rental income, and from there we get to subtract the property taxes and we get to subtract the trustees' fees that are going to be charged to income. And it tells us in the problem that we allocate the trustees' fees half and half. So here we have a trustee fee of $1,800. We allocate it half to income and half to principal. Notice also we did not include this loss on the sale of a capital asset because that is allocated only to principal. So here our accounting income, which is going to differ from our tax income, right, because we have tax-exempt interest and all of that, is going to be $26,100. And this is the maximum amount we can distribute, the $26,100.